You are listening to Keystone's Stock Talk Podcast, episode 142. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We have a busy show planned for you this week. In our case for, case against debate, we take a look at Care Cloud, symbol MTBC on the NASDAQ, a healthcare information technology company that provides a full suite of proprietary cloud-based solutions together with related business services to healthcare providers and hospitals throughout the United States. Brennan argues the bull case, I crush him again with the bear case, and Aaron sits in as judge, jury, and executioner. In our Your Stock Our Take segment, we answer a listener question on Northland Power Inc, NPI on the TSX, a renewable power producer which owns 2.3 gigawatts of net of generating capacity. Most of Northland's power is offshore wind, but the company also has a pipeline of onshore renewable assets. We take a look at current valuations and the company's growth prospects into the future. I'm going to welcome my co-hosts, Brennan and Aaron. How are you guys doing today?
Salutations.
Excellent. How are you, Ryan? I hear there's going to be some new additions to the household soon.
I think you're speaking too soon. There was a proposal put forward in my household, to add at least one to possibly two cats to the mix here. And
why stop
I'm pushing
at two?
back.
Come on,
I'm pushing
10.
back. Yeah, just why not get two and they can breed and just stay here forever and be a cat convent here.
The one cat that Ryan currently has been the cause of quite a bit of mayhem in the office.
Look, I don't mind cats. Like, that's the thing. I don't want to be painted as this cat hating. I mean, cats are cool, but
didn't it tear up the cat I have right now or something the other day?
The cat I have now is it causes massive destruction in the house. I have not been able to put a screen in. Like, we put all new screens in, bought a new house, new screens, and they're all destroyed. So we replaced one, and within 2 days it was ripped in half again. Our weather stripping all over, it just ripped. Literally, we're sitting here. The cat's like 14, 15, and it's.
You got to bring up your L key too. You got to bring up your L key on your keyboard. Because wasn't that from the cat?
Oh, yes. Okay. Well, I was showing my family our latest webinar, and I just put the laptop on the ground, and we were laughing at the start. There was a little funny bit at the start, and they were laughing. Then the cat walks over to my keyboard, knowing I think it's my keyboard, and just starts to, scratch across the keyboard, sharpen his claws, rips off the L key. I've had no L key for like 15 days. It's really, you use the L more than you'd think. Yeah. And finally got it replaced the other day, and it's just wonderful. But the cat has it in for me.
Yeah, there was a couple confusing emails that I definitely got from you over last week, just missing that L.
It'll be interesting to see what keys the new cats tear off your keyboard, Ron.
This cat tears things off my feet, face, everything. I wake up in the night, my toes all bloodied, and there's a cat smiling at me. This cat is it's a piece of work. Anyways, it's also a black cat, which is just great. Like, so everybody thinks there's bad luck around this cat too. But no, the cat's actually maybe not as bad as I'm saying.
You love her.
It's named Bella.
You love her.
We do love the cat. But we'll see. Maybe adding two or none if I have my say in it, which often I don't. So let's get into, we were going through a couple segments from our DIY investment webinars, details, common mistakes investors make when they build their DIY portfolios. Last week, we talked about not committing to the process. Today, I'm going to look at kind of acting like a trader. I'm just going to do this really quickly. For the average investor, I'm going to put it bluntly, trading is a bad idea. Now, how can you identify if you're trading too much in your portfolio? If you see hundreds of trades in each month on each monthly statement, or even in a year, this is too much movement in most cases for the average investor. Even 50 plus trades in a year can be symptomatic of something wrong for the average long-term investor. Either you're buying the wrong stocks or you do not have a realistic time horizon or holding period in mind. To give you an example in terms of what trading does for investors, in our June 2020 webinars, just under a year ago, we put together an entire section on day trading using empirical studies. The finding in the most recent credible study in this area, I'm going to quote it directly here, said, "It is virtually impossible for individuals to day trade for a living." The study found that 97% of all individuals who day traded for more than 300 days lost money. Well, those are not good odds. As an investor, stocks you buy should be with the goal of holding the stock for 2 to 5 years as an investor, or really as long as possible, as long as the business continues to perform. Your thoughts on that, guys?
Yeah, I think the one thing about trading is it's so hard to manage your emotions. Now, in investing in general, it's pretty hard to manage your emotions, but especially with trading, when you are watching the swings very closely, it makes it that much harder to actually win. Like, for example, I love buying a stock, knowing the fundamentals are good, setting it and forgetting it essentially. As long as that company continues to grow, just don't worry about, the short-term noise of the market and the swings. As long as the fundamentals are there, buy and hold long-term. And, that's, again, just the thing I think that is very, very hard about trading is, those quick swings. You're looking to, make a quick buck emotionally when all of a sudden you see that you're down, however many percent, because, you're trying to make money off of small swings, essentially. I just think it's such a hard thing to do. And yeah, I think, it's great to, take some of the emotion out of it by, long-term investing, essentially.
Most of the investors that I speak to don't want to sit in front of their computer screen for the entire day trading stocks.
Most of them have
either.
jobs
or lives. They want to, maybe they're retired,
lives,
or they have kids. They want to spend time with the family and not just be glued to the computer screen. So, trading, it's clearly some people, perhaps professionals, can make it work. I'm sure some people do make money over certain periods of time, but it's certainly a lot easier to make money as a trader when the market is going up, of course, because you can make mistakes and still make money unless you're primarily short and you have a net short position. But I really see investing as more of being a business person, a business investor, right? Like you're somebody, you think of yourself as a business investor who's going around looking for innovative companies that you can take a position in, and you want to own those companies as they execute that strategy. And the execution of the strategy, the growth strategy, isn't going to happen in 1, 2, 3 days, or in a couple of minutes. It's going to take, a couple of quarters, a couple of years even. So the healthy way of approaching an investment is to look at it with a minimum time horizon of 1 to 3 years. That gives the company time to execute the strategy and for that to actually be demonstrated in the financial performance. And if that happens, you find a company where the earnings per share are growing, the revenues are growing, it's not overly leveraged, and it's part of a market that is providing an opportunity for growth long term. The stock price is going to follow that financial performance over time. So that's really the way that we look at investing is as if we are really business people buying pieces of real businesses.
Yes. Yeah. And as Buffett was always famous for saying, Graham's quote, investing is most intelligent when it is most businesslike. And that's what you're talking about really there, if you look at it from that perspective. And, the final point that I would make is, if you're trading, many people really want to spend time with their cats rather than trade, right? So, I mean...
such as Ryan.
Such as me. I just want more time with my cat or more cats at this point, right? So if I can do that, and if I can buy and hold great companies and spend more time, having my toes ripped off by my cat, that's something that I'm looking forward to going forward.
Well, it seems like you'll have lots of opportunities to do that, right?
We shall see, and we'll keep you updated because everybody out there, I'm sure, is on pins and needles to see if we do get those cats, right? Mm-hmm. Now, the case for, case against debate. We're going to look at Care Cloud Inc., MTBC on the NASDAQ. Current price $820, market cap just over $102 million US. Care Cloud is a healthcare information technology company that provides a full suite of proprietary cloud-based solutions together with related business services to healthcare providers and hospitals throughout the U.S. Let's look at the case for Brennan. You ready to get your butt kicked?
Of course. I'm always ready to get my butt kicked. Yep. You bet.
Okay,
Sounds
Brennan.
a little strange, but...
You know the rules. 1 minute. You tell me when you're ready to go.
I am ready to go. So just let me know.
Go.
Number 1, Care Cloud operates in the exciting space of healthcare information technology and provides a wide set of software as a service solutions to healthcare providers, which is of course attractive. Number 2, they have great fundamentals where revenue grew to $105 million or 63% in fiscal 2020 compared to fiscal 2019. Adjusted EBITDA grew to $10.9 million or 34% over 2019. Plus the company has a cash-rich balance sheet with approximately $9.5 million in net cash. Number 3, the company anticipates growth to continue, providing 2021 adjusted EBITDA guidance of $23.5 million, which equates to about 115% growth from 2020. Number 4, the company trades at a reasonable EV to EBITDA multiple with a trailing figure of 25 times and a forward multiple of just 11.5 times. Now, to sum it up, it's in an exciting space. They have SaaS revenues, solid fundamentals, good expected growth in 2021, and last but not least, trade at a reasonable price. Oh, I got that out. I was stuttering a little.
Yep. All right.
Oh, there you go.
Couple seconds to spare. Okay. Ryan, are you ready to present the case against?
Always ready.
Okay. All right, tough guy. Go.
So on the surface, Brennan's case paints a beautiful picture for Care Cloud. Unfortunately, that beauty is only skin deep. While the growth outlook is impressive, the capital structure is not. Care Cloud has funded its growth through the issuance of preferred shares, which pay a pricey 11% coupon. In 2020, the company generated funds from operations of $10.92 million, which sounds great, but they paid out $13.9 million in preferred dividends. Adjusted EBITDA is misleading as the huge interest burden the prefs create is pushing actual cash earnings negative. While the growth guidance looks great, I point out that management downgraded 2020 adjusted earnings guidance from 12 to 13 million to 10 to 12 million, bringing the question of the level of one weight should put in their current guidance year over year. At present, the stock is not cheap, trading at a generous 25 times EV to EBITDA. And now, on top of it, the CEO is leaving with no dedicated replacement. Capital structures matter. In that case, the pricey press prevent purchase. Alliteration at its finest. Yeah. I didn't even hear you say start at the start of that, so come on.
Wow, he's just making excuses now. Hey, Aaron.
I don't have to make any excuses. I laid out the case well enough.
I don't know. If somebody keeps going after the buzzer, does that not disqualify them, Brennan?
I think.
Hey, if he wants to win on a disqualification, then that's great.
A W is a W, my friend.
A W is a W.
There'll be no disqualification. I'm just going to disregard anything that Ryan said after the buzzer. I think that's fair. Okay, so
I don't even need that.
We'll see. We'll see. So obviously this company has all the buzzwords: cloud, digital health, SaaS, everything. But that capital structure is problematic. I mean, I have to say, Brennan really did paint a pretty good picture. I think that if you're looking at a company that's in an exciting theme like this, a software-based company, 25 times EV to EBITDA is not that expensive at all. I certainly, in my research, see companies in the software space trading for far higher valuations than that. But I have a bit of a problem with the capital structure when it comes to the preferreds. I mean, 11%. That's a pretty healthy yield. It's a lot of cash flow that has to go out, and I would agree with Ryan that reporting adjusted EBITDA, but then reporting that as before charges before payments to preferred shareholders is misleading. I don't like that. ultimately, when you're talking about growing the company, it's really the common shareholders that are invested in that. So if you're talking about growing the EBITDA, common shareholders want to know what it's in it for them. And I wouldn't have a problem with that if they had another line item which also reported adjusted EBITDA purely for the common shareholders, but I didn't hear of anything like that, so I just have to assume that they don't. The question is, would I invest in this company right now, given what I've heard? Well, with guidance declining, with not much profitability, I can't really justify. I mean, that 25 times EV to EBITDA multiple doesn't really hold a lot of weight to me. I wouldn't mind paying a multiple like that for a great company if I was getting that visible growth and that cash flow that I knew was coming to the common shareholders. But in this case, I'm not really clear that that's what's happening. So I'm gonna have to give this one to Ryan.
No, just kidding. No, that was good. And I initially thought that I had a great case to win until I looked at those prefs. It's just it's hard to make the case, the for case, when they're paying out more in dividends than they're pulling in from FFO. And it's just, as a common shareholder, technically no money. There's no value creation to the common shareholders, essentially. So
I like things simple, right? Like when I'm investing, and this is what we always say to our clients, to investors, you want to keep things simple. Don't invest in something that's so complicated you don't understand. And when you have these more complicated capital structures, and you could say, well, preferreds are fairly common, but when all of the cash flow is basically being soaked up by the preferreds, then some, it's not really clear like what is actually attributable to the common shareholders. That just complicates the whole situation for me. I've seen structures like that in the past, and they haven't really worked out for the companies. So for me, maybe the company will do something down the road that would change my mind. It certainly has the opportunity to do that. But from what I heard, I wouldn't be rushing out to buy it. I mean, the CEO's leaving. Being a small cap company, that could have a big effect. So there's just a lot of there's just a lot of things that I think would stop me from.
And
investing.
we talked to management. What was that? Maybe about a year ago now. And
we did.
And this they basically stated that they went with this, or they went with the prefs because they don't want to dilute shareholders or common shareholders. But I mean, realistically, is this a better case? I don't know. I would argue that it's probably not.
Yeah, in the end, you are diluting.
You are exactly.
You're trying to. The markets and investors aren't stupid. You can't get around the fact either you're raising money if you need to raise. If you don't have the free cash flow to just generate cash and buy out of cash flow, if you put the structure in place this way or you issue shares, you can't get around the fact that there is dilution to common shareholders in this case. They're trying to game the system. They think they are. They think this is a way of not diluting, but you are.
Yeah.
And it just. When we've seen these structures in the past, people think they're very smart in doing this, but they're not priced off of EBITDA then, because you can't be, because you're pulling out that massive amount of interest. So if you're
so smart, show me in how you grow the business, not in some complex way.
Create your capital structure. And I said, this is what I was trying to say at the end, and I went like half a second over, but I wanted to say, and it was my little
I think it was more like 2 or 3, but we'll
2 or 3 halves of a second. I agree. So capital structure matters. In this case, pricey prefs prevent purchase. That is my alliteration right there. And
Nice.
in the case of CareCloud, or MTBC, as it was called when we originally interviewed management, that is the one reason a year ago, because everything looked quite good, but that capital structure prevented us from really recommending the company.
Yeah.
And it's been a good call, and it hasn't gotten premium valuations in a sector that really has been quite hot. So, and
pricey prefs prevent purchase. Is that yours? Did you come up with that?
I came up with that. If that would have came in there. Is
that Ryan Irvine's 4P methodology of investing?
That's the 4P. That's the 4P. Yeah,
But
there's a lot of P in that.
It is interesting.
I like it. No, it's
too
very
that
creative.
like with where interest rates are, like and they don't even have that much debt, if any, really on their balance sheet. Like I'm surprised they haven't really utilized debt, as a means of funding rather than these expensive prefs. But I mean, again, we could talk about this forever, but it is an interesting case. The business does look great, but then, this is definitely a dark cloud over it in my mind.
And if they hit that guidance this year, then, maybe, you can revisit even with the pricey prefs, and maybe they, at some point they take those out. But, it's just right now that's what we're looking at. And, like we said, you can't value it really on EBITDA because of the massive interest payment really that they pull out. And you got to look at these things and look deeply when you're making investments in companies like this. And that's why we do prefer cleaner structures. And you guys detailed that simply.
And one last thing.
I had to give Ryan, out of respect for a cleaner capital structure, which we always highly respect here at Keystone, I had to give Ryan the win out of respect to that.
Oh, that makes sense.
Nothing to do with his
one last thing.
debate.
I just want to say that if they were to buy the prefs out,
for Brennan.
if they were to buy the prefs out, I'm pretty sure they'd have to spend about $140 million just to buy the prefs out too, and that's a lot of cash.
So in the end, they'd probably have to go out and raise capital by issuing equity. So you do end up diluting shareholders. It's just, you don't get around that. There's no way to game the company structure or whatever they're trying to do, or whatever anybody who uses this structure is trying to do, especially in a smaller cap oriented company. You're not going to fool the market. Short term you can potentially, but over the long term, they're not going to value based on that. You're going to look at measures like operating cash flow, FFO, free cash flow. That's what you're going to look at. And it doesn't look too pretty with this business, despite the revenue growth that we've seen. And that's probably why they trade at a forward looking EV to EBITDA, if you wanted to use that is quite low. But, it's not really, it's kind of misleading. It is misleading. Now let's look at our Your Stock, Our Take segment. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We're going to look at Northland Power Inc., NPI on the TSX. Aaron, this is yours. You got a listener question on this one.
Excellent. Thank you, Ryan. So Northland Power, currently trading right now at about $43. It's an almost $10 billion market cap company, and they are a renewable power producer. Northland owns 2.3 gigawatts net of generating capacity. They also have a significant inventory of early to mid-stage development projects, which could add an additional 4 to 5 gigawatts capacity, potentially. Most of the company's power is offshore wind. They also have some onshore renewable assets as well. The company's executed a very aggressive growth strategy for years. This strategy has generally prioritized growth in the size of the company over accretive growth in per share earnings and cash flow. Recently, on April 14th, the company announced an agreement to acquire a portfolio of 540 megawatts in Spain for a total cost of about $1.1 billion Canadian. This is a large acquisition for the company. The cash flow from these assets is contracted and predictable, and Northland expects the transaction to be immediately accretive to free cash flow per share, but they did not specify by how much. The Q4 results were released on February 22nd. Revenues in 2020 increased 24% to $2.06 billion, and adjusted EBITDA increased 19% to $1.17 billion. Adjusted free cash flow per share did lag this growth, increasing 6% to $2.09. The company has also provided guidance for 2021, and they expect adjusted free cash flow in the range of $1.80 to $2 per share, so down between 4% to 14% compared to 2020. Big opportunity the company thinks going forward is their large pipeline of potential development projects. As I said, this could add an additional 4 to 5 gigawatts to their existing capacity, and the company believes that it would require a net capital investment of $10 to $14 billion over the next 5 years. Once these projects are in place, assuming they are actually built, the company believes that they can more than double their adjusted EBITDA in the latter half of the decade. So what are our thoughts on Northland? Well, Northland has benefited from the trend toward renewable power and decarbonization, and we certainly expect that this trend is going to continue. The aggressive growth strategy has been focused on increasing the overall size of the company over growing the per share earnings and cash flow. We prefer a strategy that is more focused on growing the per share earnings and cash flow. But that said, to be fair to the company, cash flow per share has been growing over the years, just at a lower rate. In the last couple of years specifically, the growth in per share performance has really slowed. Guidance for 2021 puts cash flow about where it was in 2018, in spite of adjusted EBITDA increasing almost 30%. So what investors need to consider is that when the company is targeting doubling their adjusted EBITDA over the next 5 to 10 years, you can't just assume that the growth in per share earnings and cash flow is going to mirror that adjusted EBITDA growth. It's more than likely, it's certainly going to fall well short of that, and more than likely substantially short of that. But overall, we do think that this is a solid business. It's in an attractive theme. It has stable cash flow. I'd like to see more of a focus on per share growth. It's not particularly cheap at about 22 times expected 2021 free cash flow, especially considering that cash flow is expected to decline in 2021. In the near term, the company looks fairly valued to me, but over the longer term, say a 5 to 10 year time horizon, the company could continue to do well, particularly if it produces better per share accretive growth from its development portfolio and acquisition.
Perfect.
Yeah, no, it's a good summary on the business. We have a couple names that we did a full sweep on the renewable power sector in the summer of last year, late summer. Came out with a special report that included a full synopsis of that segment within the Canadian market. Came out with a couple buys in there, which we still have active long-term buys on going forward, which would be would trade at lower multiples than Northland right now. This is not to say Northland, like Aaron said, is a poor company, but we do see some, potentially better value in those two companies, and our clients are very aware of who those businesses are.
Yeah, and this is just off the top of my head too. Does Northland not utilize a lot more debt compared to a lot of the other utility companies? I mean, I might be completely wrong here. This is just off the top of my head. I thought they were highly leveraged.
So the debt to equity ratio is quite high. I believe it was about 4 or 5 times. We could have gotten into the balance sheet as well. One of the reasons why companies, particularly in the utility space, the power gen space, can sometimes get away with having higher debt levels is because most of their revenues and cash flow are either contracted or regulated. So because they have such high certainty of what's going to come in over the next several years, they're able to hold higher debt levels. Now, that said, the debt level of Northland is definitely on the high end as well. So, and this is all part of their very aggressive strategy for growth, right? And that's one of the reasons why, in spite of us seeing massive increase in revenue and adjusted EBITDA over the past few years, the free cash flow per share has not really grown that much.
Yeah, that makes sense. Because that
now,
interest
over time,
is going
if you want to go back 7 years, 8 years, you've seen better growth between then and now. But certainly over the last 2 to 3 years, it's really slowed.
Yeah.
All right, well, that's going to end off our show for this week. We keep encouraging you to send your questions in to our Your Stock, Our Take segment, to our Ask Us Anything segment, and also to our Case For, Case Against, and we'll endeavor to answer those in an upcoming show. Rate and review us on iTunes or wherever you get your podcast, and we'll keep putting out the content. We keep getting more and more listeners each week, which is great to see, and we'd love to have more, so tell your friends about us, and we'd love to have you listening on a go-forward basis. I'd also wish you out there profitable investing. Thank you.
Thank you all. Profitable investing.
Thanks, everyone.